All right, let's dive right into the latest earnings from mortgage REIT Dynex Capital. That's ticker DXX. Now, they posted some seriously impressive numbers, but the market's reaction was, well, kind of muted. So what is going on here? That's what we're going to figure out.
Okay, so let's just get right to the heart of it. The whole story of Dynex's quarter is right here, and it's a tale of two completely different metrics. On one side, you have a miss on what a lot of investors watch like a hawk, their earnings available for distribution, or EAD. That came in at 22 cents a share, a full 5 cents below what the street was looking for. But then, on the other side, you've got this massive beat on book value, which jumped by 78 cents per share. That fueled a frankly incredible 10.2% total economic return for the quarter. You see the problem here? This is the central conflict we've got to unpack.
So you see a number like a 10% economic return, and you're thinking, the stock has got to pop, right? Well, this was the market's reaction on earnings day, down about 0.5%. I mean, it's not a disaster, but it is definitely a shrug. And that brings us to the key question we need to answer today. Why did a relatively small earnings miss seem to totally overshadow a huge gain in the company's real, underlying value? Right, so let's dig into the weeds a little bit. We need to really understand the numbers behind this very mixed signal the market sent.
You know, management's message on the call was crystal clear, and it really started with co-CEO Byron Boston here. They're playing the long game. The focus for them isn't about hitting one specific quarterly number, it's about building a business that's resilient, one that can compound value for shareholders over decades. This quote, it pretty much frames their entire strategy.
So what was behind that earnings miss anyway? Well, here's the funny part. It was actually a direct result of their own success. The company had a monster of a year in 2025, delivering an almost 30% total shareholder return. And because of that amazing performance, it triggered higher incentive-based pay for the team. That hit the expense line, and that's what pushed that key EBD number just below what analysts were expecting.
And that really sets the stage for what this earnings call was truly about. It wasn't so much about the results from one quarter. It was really about management pulling back the curtain and giving us a look at their strategic playbook for some pretty serious growth ahead.
And I gotta say, their playbook is refreshingly simple and really powerful. Step 1, you raise capital, but only when you can do it without watering down your book value. Step 2, you put that capital to work right away, deploying it into your core assets, which are mortgage-backed securities. And Step 3, you aim to generate really attractive hedged returns for your shareholders. It's just a clean, clear cycle that they've been running on repeat, and they have been doing it aggressively.
Now, what's really wild is when you look at the sheer scale of how they're executing this plan. We're talking about raising roughly $1.5 billion in new capital in just 13 months. And look at the portfolio. It went from $9.8 billion up to $19.4 billion. They literally more than doubled the size of their portfolio in 2025 alone, all while keeping leverage in check, aiming for the low 8s, and targeting mid-teens returns. This is a company in full-on scaling mode.
Okay, so they've built the machine to scale up, but what's the fuel? This is where we get to what might just be the most critical part of their whole story looking forward. It's a huge policy shift happening in Washington that management thinks is creating a powerful tailwind for their entire business model.
And this all comes down to the government-sponsored enterprises, or GSEs. You definitely know them as Fannie Mae and Freddie Mac. The big deal here is that they've gotten the green light to start growing their investment portfolios again. This turns them into huge, active buyers of the very same assets that Dynex holds. And that, in management's view, creates a fundamental backstop for the entire market.
This quote right here from the Q&A part of the call, it just perfectly captures their thinking. Having the GSEs in the market as a guaranteed buyer, it reduces what they call tail risk. That's just Wall Street talk for the absolute worst-case scenario where the market panics and mortgage spreads just blow out. So the idea is, yeah, maybe returns are a bit lower now because spreads are tighter, but the overall risk-adjusted picture is way, way better because that extreme downside is basically off the table.
So what does this all really mean? Well, it signals a fundamental shift in the market itself. For a while now, management had been calling the period of super wide spreads a generational opportunity. On this call, though, they pretty much declared that opportunity over. We are now in what they call a normalized environment. And the trade-off is clear. You're giving up some of that huge potential upside in exchange for a whole lot more stability and much, much lower downside risk.
Okay, so we've got the earnings miss, we understand the scaling playbook, and we see this new policy environment. With all of that in mind, what's our take on the next quarter? Let's look ahead.
So here's what we're going to be watching really closely. On the positive side, a big catalyst will be seeing their expenses normalize. That should get EAD back on track. And of course, we want to see continued stability in that all-important book value. The risks? Well, spreads could tighten even faster than their hedges can keep up, and that would squeeze their profit margins. And you always have the risk that policy changes could encourage homeowners to refinance. When that happens, investors like Dynex get their money back sooner than they planned, which can hurt returns. In the business, we call that negative convexity. So let's get specific and put some predictions out there. For next quarter's EAD, we're forecasting a rebound to around 25 cents a share, mainly as those one-time compensation costs fall away. As for the stock price, we think it's going to be pretty range-bound. See, the market's already baked in that strong book value growth. Now it needs to see the earnings power come back before it's willing to bid the stock up. The real key catalyst will be that next book value update. That's what's going to prove whether this new, tighter spread world is still creating value for them.
And all of that brings us to our final rating for Dynex Capital. We're calling it Market Perform.
So why market perform? Well, because right now the story feels perfectly balanced. On one hand, you have this incredibly powerful book value growth and a really convincing argument from management about a safer, policy-backed market. That is super compelling, but you just can't ignore the short-term pressure on earnings and the fact that a lot of the easy money from spreads tightening has probably already been made.
And that brings us to our final segment, where we step away from the core analysis and float a bit of a wild yet plausible idea, straight from the trading floor.
We like to call this one the hedge fund pitch. So here's the idea. It's a pairs trade. You go long Dynex Capital, betting that their sheer scale and their sophisticated strategy are just perfectly built for this new, more complex market. A market where being able to pick the right securities, what we call alpha, is everything. And at the same time, you short a broad mortgage REIT ETF, something like REM. The thesis is that an ETF gives you exposure to a lot of the smaller players who did great when the whole market was just rising, the beta trade, but who might really struggle to generate actual returns in this new, tighter, lower-risk world. It's really a bet on a best-in-class operator against the rest of the field.
And as always, we have to end with our final and most important point. This is not financial advice.